Next guest says they're the perfect place to look for bargains right now, with EM stocks outperforming U.S. equities over the last 5 months and PE ratios at some attractive levels. Joining us on the phone today, Mobius Capital Partners founder Mark Mobius. Mark, it's great to have you back. How do you describe right now the picture in EM, given all of the hand-wringing that's going on here stateside with regard to the Fed?
Well, it looks very good, actually. It's really interesting to note that while the Fed is considering raising rates, a lot of these emerging market countries are lowering rates. I'm here in Brazil, and they're looking to lower the rate. Central bank here in Brazil is lowering the rate. Chile is looking at that as well, and some other countries, I think Mexico as well. So it's very interesting to see how this is all played out. But in these emerging countries, because of the Ukraine war, it's beneficial in many ways for the countries that are importing oil from Russia at a lower price, of course, than they were paying before. So it's very interesting to see what's happening in these countries. Of course, mixed picture. Some are benefiting, some are not. But I would say the outlook for emerging markets looks pretty good for this year.
So what do you buy with that kind of backdrop?
Well, we are very bullish on India. We're still in Taiwan in a big way because the chip revolution is not ending. There's lots of great bargains in Taiwan, despite all the problems with China. And India is growing at a rapid pace, probably one of the fastest growing countries in the world today. So that's where we're looking.
Is that really a bullish thing if they're cutting rates and we're raising rates? Doesn't that hurt their currencies a lot and make it harder for them to pay dollar-denominated debt and just suck liquidity out if the Fed's doing the opposite?
Well, you're absolutely right. I mean, if their currencies are going to weaken, which, by the way, they haven't, because if you look at the U.S. dollar index, you'll see that the U.S. dollar index has fallen. And a lot of these emerging market countries, because last year their currencies really went down a lot. Now they're recovering. Even if their currencies are weak, their exports can do well. And many of these countries are not that dependent upon imports. So it's a mixed picture. It depends on what area you're looking at. In the case of India, for example, they're getting cheaper oil from Russia. And, of course, they're going to become a bigger and bigger exporter as guys like Apple and the others go into India to start manufacturing.